The importance of backtesting your trading strategy is often misunderstood because it produces no immediate dopamine, no thrill, and no visible proof that you are getting closer to profits. Yet, among professional traders, backtesting is quietly regarded as one of the most honest and humbling stages of the journey. It is the place where fantasy meets data, where assumptions are confronted by reality, and where ego is either refined or exposed. Backtesting does not exist to impress you with how good your strategy could be. It exists to teach you how it behaves when conditions are uncomfortable, uncertain, and repetitive, because that is where real trading actually lives. At its deepest level, backtesting is not about the market at all, but about expectation. Most traders suffer not because their strategies are bad, but because their expectations are fragile. They expect progress to be smooth drawdowns to be short, and winning streaks to confirm skill. Backtesting systematically dismantles these expectations. By forcing you to walk through dozens or hundreds of historical trades, it reveals the true rhythm of a strategy: clusters of losses, long flat periods, sudden recoveries, and uneven growth. This exposure is psychologically invaluable. It replaces surprise with familiarity, and familiarity is one of the strongest antidotes to fear. One of the most powerful lessons backtesting delivers is the normalization of loss. Before backtesting, losses feel like personal failure. After backtesting, losses become statistical events. You see how often losing streaks occur even in profitable systems. You see that being wrong several times in a row is not an anomaly, but part of the design. Trading literature consistently shows that many traders abandon good strategies simply because they were emotionally unprepared for normal variance. Backtesting prepares you for that variance before real money is at stake, which is why it is often described as emotional training disguised as analysis. Backtesting also forces clarity where ambiguity likes to hide. Vague rules survive easily in live trading because discretion and hindsight blur accountability. In backtesting, ambiguity becomes obvious and painful. You are forced to define exactly what constitutes an entry, an exit, and an invalidation. You cannot take a trade in historical data. This precision is uncomfortable but essential. Many traders discover during backtesting that what they thought was a strategy was actually a collection of loosely connected ideas. This realization alone can save months or years of unfocused effort. Another critical role of backtesting is separating edge from execution. When live trading results are poor, traders often do not know whether the problem is the strategy or their behavior. Backtesting removes behavior from the equation. It shows what happens when rules are followed consistently. If results are negative in backtesting, discipline will not fix it. If results are positive but live trading fails, the issue is psychological or procedural. This distinction is invaluable. It prevents endless strategy hopping and redirects attention to the real bottleneck. Backtesting also retrains patience in a subtle way. Watching price unfold historically, trade by trade, reveals how much time markets spend doing nothing. You see how often price almost works and then fails, how long trends actually take to develop, and how rare clean opportunities truly are. This experience reshapes intuition. When you return to live markets, you are less tempted to force trades because you have already seen how little action is actually required for an edge to play out. Patience stops being theoretical and starts feeling logical. Importantly, backtesting also acts as an early compatibility test between trader and strategy. Some strategies win frequently but lose big. Others lose often but win big. Both can be profitable on paper. Living with them emotionally is another matter. Backtesting lets you feel this discomfort safely. If you already dread the drawdowns or frustration during testing, that signal matters. The best strategy is not the one with the highest expectancy, but the one you can execute without self-sabotage. Ultimately, backtesting changes how a trader thinks. It shifts focus from prediction to probability, from individual trades to distributions, from excitement to endurance. It teaches that success in trading is not about avoiding uncertainty, but about becoming familiar enough with it that it no longer dictates behavior. And it is precisely at this point, when backtesting stops being something you rush through and becomes something you respect, that it begins to reshape not just your strategy, but your entire relationship with the market. A relationship that continues to evolve quietly, as long as you remain willing to confront reality before risking capital and to let evidence, rather than hope, guide your next decision. And this is where the deeper work of backtesting has not yet fully reached its end. Because when backtesting is treated as a discipline rather than a task, it begins to shape the trader long before it shapes the equity curve. This is the phase where repetition turns information into intuition. After enough historical exposure, the trader no longer asks whether a losing streak is abnormal, because they have already lived through dozens of them on paper. They no longer panic when price hesitates, because they have seen how often hesitation precedes continuation and how often it precedes failure. This familiarity does not eliminate uncertainty, but it removes surprise. And surprise is what fuels emotional mistakes. As backtesting deepens, traders also begin to notice how their own biases show up even in historical analysis. They skip losing trades unconsciously. They adjust rules slightly to make results look cleaner. They favor periods that fit their narrative. Catching these behaviors is uncomfortable, yet profoundly useful. Trading literature often notes that backtesting is one of the few environments where self-deception can be observed safely. The trader who learns to be brutally honest in backtesting is far better equipped to remain honest in live trading, where the emotional stakes are higher and rationalization is easier. Another advanced benefit of backtesting is learning when not to optimize. Many traders fall into the trap of curve fitting, adjusting parameters, until historical results look perfect. Backtesting done properly teaches the opposite lesson. Robust strategies look imperfect. They contain drawdowns. They have losing years. They survive variation rather than eliminate it. Over time, traders learn to value stability over brilliance. This restraint protects them from fragile systems that collapse the moment conditions change. Backtesting also creates a bridge between strategy and execution timing. By reviewing how trades unfold, bar-by-bar traders learn realistic expectations for entry-quality stop placement and follow-through. This reduces frustration in live trading, where many losses come not from wrong ideas, but from unrealistic expectations. When you have seen how messy real edges look historically, you stop expecting clean outcomes in real time. This acceptance alone improves execution quality dramatically. As experience accumulates, backtesting naturally evolves into scenario testing. Traders explore how strategies behave during high volatility, low liquidity trending phases, and ranging phases. This contextual understanding is invaluable. It prevents blind application of rules and supports adaptive risk management. Trading literature consistently emphasizes that edge is conditional. Backtesting reveals those conditions clearly enough that the trader can adjust participation without abandoning the strategy itself. Eventually, the most important output of backtesting becomes emotional preparedness. When losses occur, the trader does not feel attacked. When wins occur, they do not feel entitled. Both outcomes fit within a known distribution. This emotional neutrality allows discipline to hold when it matters most. Backtesting in this sense is not about the past. It is about preparing the mind for the future. In the end, the true importance of backtesting lies in what it removes. It removes unrealistic expectations. It removes surprise. It removes the illusion that certainty is available. What remains is a trader who understands probability deeply enough to act without drama. A trader who knows that drawdowns are not warnings, but costs. That patience is not optional, but structural. And that consistency is built not by predicting the next move, but by surviving long enough for an edge to express itself repeatedly. When backtesting is respected at this level, it becomes a quiet foundation beneath every decision. Trades are taken with less urgency. Losses are absorbed with less emotion. Review becomes constructive rather than defensive. And over time, this foundation supports a trading practice that is resilient, adaptable, and grounded in reality, rather than hope, allowing the trader to participate with clarity even when markets are uncertain, noisy, or discouraging, because they have already seen these conditions before and learned that they can be navigated without panic as long as preparation has been done honestly and thoroughly, long before the first live order was ever placed.